I am here with Josh Young, who is Chief Investment Officer and founder of Bison Interests, which invests in publicly traded oil and gas markets, and Tracy Schuchart, who's partner and global macro energy and material strategist at Intelligence Quarterly. Thank you so much, guys, for coming on.
Thank you.
So this is a nutrition show, and so might be an unusual kind of intersection between interests here, but I'm coming from the perspective of trying to understand what we all are already experiencing in that many people or we all really are paying more and more for food, and of course gas and other things. But also from the perspective of being able to plan for the future, both in terms of thinking about whether this is going to get worse or not. So, for example, Doomberg had come out over the weekend with an article, Farmers on the Brink, where they said they have no joy in predicting this, but they believe we're headed for a famine of globally historic proportions. And it seems like, we might be in a range where the optimistic scenario is that we wind up paying even more for food this summer. And the pessimistic scenario is it gets much worse than that. And so now, because of my audience in nutrition, there are many of us who may look at this and see silver linings in it. So, for example, many people may have the perspective of, I have been choosing to deliberately pay more for food than the average person for a very long time because I buy organic or I try to support my local farmer and things like that. And there's also in what I, might be termed like alternative ag, there's alternative agriculture. There's an idea that we have put so much emphasis on increasing yield with chemical fertilizer that we've sacrificed some of the quality of the food. And so if we have a shortage of chemical fertilizer, some people are going to look at that and say, well, now we can have more nutritious food again, and we might pay more for it, maybe we should. But I think there's a clearly humanitarian concern here because although I would like to improve food quality, I don't want to get there through a global famine. And, I would prefer to be able to return to quality or pursue greater quality from a state of abundance rather than a state of scarcity. And, on top of that, while many people may be choosing to pay more for higher quality food, many people can't afford to pay for higher quality food. They're paying, they're living from paycheck to paycheck, and they're going to wind up paying more for lower quality food because of the shortages that we seem to be experiencing. And so I want to take a look at this from understanding what, break this down to the most basic level. What are the factors of production that go into food production, and why are the prices increasing, and what can we expect from that? And it seems that, oil and other fuels and fertilizers is kind of like the bottom of the chain and the place to start. So what I'd like to do is kind of outline like where we are coming from, how we got here, and where we're going in terms of fuel and fertilizer. But before we do that, could you guys just give kind of introduce yourselves a little bit about your background? When I chose you to come on the show, I'm looking at it from the perspective of, as people who are involved in investing, you are deep in the weeds of the data analysis on this every day. But you also have skin in the game because you are, either whether it's your money or your firm's money, if you are wrong about these things, you'll lose money. So I feel like you guys are definitely among the top people to hit up to try to understand this. So could you just give it an introduction of a little bit about your background and what you do for work and how that gives you some unique insights onto these issues of the cost of fuel and fertilizer before we get going?
Sure. I guess I'll go first. So I'm Josh Young. I'm the Chief Investment Officer for Bison Interests. We do investments in oil and gas companies and have done quite well doing that over time, despite there being a very long downturn in the space. And Yeah, I guess I can speak more to the fuel side of things. And as we get closer to food, I become less of an expert and more of just an interested observer, and maybe a little bit to price inflation as well as a general phenomenon as an expert. But again, as we get closer to that, I get less comfortable, and we'll defer to Tracy and others.
Thanks, Josh. Tracy?
Yes. So hi, Tracy Schuchart. I actually started my career at the Chicago Board of Trade. So my background is in commodities, spanning agriculture through bonds, right? And so currently I manage energy and materials portfolio for a family office. And then I am also a partner and energy and materials strategist at Intelligence Quarterly, which is kind of a macro view of that industry. And being in the unique position that I am, that is studying energy and materials which include fertilizers, metals, and things like that. I have a broader based overview of like how both of these sectors interact, and how they become intertwined so much that you cannot distinguish the difference between one from the other.
That's a great segue, because my first question I actually wanted to pose to you is, what if you could kind of outline for us, Tracy, what are the key interacting components that we're looking at? So in terms of like, what's a basic list of commodities that would be traded for the agricultural sector, but also, I've not really paid attention to any of this until recently, but I'm surprised by how many, one thing that you tweeted about recently is, how are you supposed to build an oil well when there's a steel shortage?
Right.
and I've also, just like, for example, reading the Doomberg article, reading about how, oil is used to make diesel, but then natural gas is used to power sulfur cleaning from it and stuff like that. Could you give us just kind of an outline of like, what are the basic inputs that we're looking at and how are they connected?
I mean, especially if you're looking at farming, it's all energy related, right? You're looking at diesel and propane are very incremental to that industry, because that's what runs your tractors. That's what runs, and you're looking at natural gas because that's where you get your fertilizer from. So if we take this, instead of trying to grasp this on like the broader aspects, I think it would be easier to talk about this for an example wise, right?
Sure.
So we have natural gas prices that are high, right? And so that's the first problem. Then the secondary effect is that you can't produce fertilizer because CO2, you have a CO2 shortage, right? And then your tertiary effect is that meat packing companies cannot pack meat because they buy CO2 from the fertilizer companies. So we keep going down the line.
So that, are you referring to the for dry ice use in that case?
For in general, yes.
Okay.
So we have it keeps going down the line. So the higher energy prices you have means that this is going to affect agriculture. It's also going to affect metals and many other commodities at the same time. But just using it, this is an example. You have to think beyond the first effect, right? And then look to where it's rippling throughout the commodity sector. And this is why we're going to have a problem going forward as long as energy prices remain elevated. We also have to factor in, if you're looking at energy transition and things of that nature, to the metals markets, that we're going to see the same factors, because mining metals requires a high amount of energy. And so that's going to hinder energy transition as well. I digress, but trying to keep this on the agriculture
Oh, I mean, feel free to digress as much as you want. I think this, the reason that we're having the discussion is because it relates to food, but now that we're having the discussion, I would say open it up as wide as we need to understand these things. All right, so then, if energy is kind of at the bottom of this, let me pose this question to you, Josh. If I'm looking at just, I guess, the price of oil as a most basic metric, and you can, correct me if I'm wrong in viewing that as kind of like a general index of the price of energy. But if I'm just looking at oil futures over time, it looks like there was a high price regime with quite a bit of volatility leading up to some like 2000, 2000 somewhere in the 2012, 2014, something like that. And then from 2015 or 16, basically to the wild COVID bottom, we were governed by a regime of low prices. So in terms of like setting the stage to try to understand where we came from to get here, could you give us a little bit of background on what was like energy, the state? How would you characterize the state of energy markets in the U.S., Europe, and globally during this 2015 to 2019 period prior to the COVID epidemic?
So as you're saying that, I was thinking about the grayer hair that I have and the wrinkles that I have that have formed over the course of this very long bear market. So there's been a kind of cyclical downturn in commodity investing since roughly a cyclical peak in around, let's say, 2012. And there had been, prior to that, a big investment boom as China and to a lesser extent India had urbanized, and as their GDP per capita had grown a lot, and with it, consumption of various commodities and especially oil increased a lot per person. And because there were a lot of people there, that increased consumption a lot worldwide. And so for a long time, there was this regime where commodity companies needed to produce more and more every year, and the ones that were best able to grow more were rewarded for it. And part of that ended up yielding, I guess, that impetus over enough years yielded a number of different interesting technologies that improved the ability to generate short cycle improvements in production, in particular for oil and natural gas, in particular in the US and Canada. And it's not an accident that it happened there. There's free markets. There's, relatively speaking, there's more free property rights where the ownership of land and the mineral rights on land are predominantly privately held. And so there's room for the landowners and for labor and for companies to kind of all make money through development of stuff and innovation. And so what happened kind of in the 2015 to 2019 timeframe is there was this conjunction of this productivity bubble, essentially, or productivity wave from a huge amount of investment over the prior upcycle for oil and commodities that kind of, again, peaked in 2012, but the benefits didn't. The benefits took a number of years after to peak. And there was a combination of this productivity benefit with a private equity benefit or wave along with private credit, where people are very familiar with what happened ahead of the financial crisis, where all these banks and non-financial institutions gathered lots of capital to make a one-way bet on housing. So there's been this giant wave of capital towards private markets, in particular credit and equity on the private side. And there's just this mistaken belief that there are characteristics of those that make investments better and or safer. And it's just not true. But sometimes it takes terrible things happening for people to change their understanding or beliefs. And there's lots of institutional inertia and lots of other aspects of that. And so what happened in 2015, 2019, that's kind of the backdrop, is you had improved technology meeting almost unlimited capital, and shale in particular was this great place to go deploy private capital because you could deploy it and see the results very quickly. And the problem was that individual investments that made sense in aggregate made no sense because you ended up with markets that were flooded. And then ironically, that's led now to actually starting in roughly, I think it was 2018 or so, oil well productivity started to fall in shale wells kind of in aggregate. And then gas productivity is just starting to fall or peak out now. And so what you saw was this rush to deploy capital into diminishing returns, both because too much capital was deployed, as well as because productivity improvements were peaking, while at the same time, a lot of the investments in technology and other stuff that we saw in the past cycle weren't happening. It was all very, very short-sighted, very kind of hot money going for really specific things with limited time frames. And we're now, COVID, I think, exacerbated this, but we're now on the other side of that and on the back of one of the most egregious malinvestment booms in the history of mankind.
That's really interesting. So this is not the first time I've heard something like this, but basically there's a commodity cycle and there's a credit cycle, and they both would have kind of put us where we are now, but COVID might have worsened it or pulled it forward or something like that. Let me try to say back to you what I got from that, and you can correct me. So first of all, is shale and fracking, is that the same thing?
Yeah.
And that's and what are could you just like summarize the main what is that what's the sort of elevator pitch for why shale is so great?
Well, it's not great. It's just technology improved. One of the books I have back here, it's a little covered by this I love oil and gas hat, but it's Twilight in the Desert. And much maligned Matt Simmons realized that reserve claims by various OPEC countries, which ostensibly had unlimited oil, were materially overstated. And some of the problems he identified were mitigated for some amount of time, but it looks like we've hit our peak conventional oil, which means we've hit our peak kind of cheap oil. And since that happened, it's gotten harder and more expensive to get additional oil. And there's always been this difficulty curve. People now are more familiar with that with like Bitcoin or crypto, but there's been a difficulty curve. And it's true for natural resource production and extraction kind of generally. And so it makes one almost Malthusian, except understanding technology does solve a lot of these problems over time. But the problem with shale, and as well as the benefit, is it's a very expensive and energy intensive resource to extract. So when you frack it, you're basically the way the technology has evolved, you drill wells vertically down and then horizontally through generally a very thin layer of rock. And that rock sometimes has some natural fracturing or natural permeability. But what characterizes shale, and usually it's actually not shale rock, it's usually other sorts of rock that just have been blanketed as in this sort of shale category. So it's really tight oil or tight gas is kind of the more correct way to say it. But that is then fractured to extract oil or gas that would have been difficult to extract without that technology. So when they say fracking, with shale, they're kind of used interchangeably. Other sorts of wells are sometimes fracked, but for all intents and purposes, really the bulk of the fracking sort of activity is for tight oil. And the reason that matters so much is that you're creating pathways for oil or natural gas to come out of very tight reservoirs. And so intrinsically, these are resources that come on with a lot of production at first, because you've opened essentially you've created your own porosity. You've like opened up rock. But once that rock has been drained from the parts that you opened, you're now trying to access some of the matrix permeability, essentially trying to get the production from the rock that's not right next to what you just blew up. And that is much less productive, and that productivity falls off very rapidly as you end up with, there's like pressure depletion functions where you have, it's almost like a membrane where you end up making it difficult for oil or gas to actually flow through. So that all matters because you you hit it with a lot of capital, you hit it with a lot of energy and steel and equipment, and obviously water and proppant, and then you get a bunch of oil or gas back real fast, and then it falls off a cliff. And so it really requires a lot of reinvestment.
Go ahead.
I just wanted to add, in some, I think, the reason that fracking and shale oil is so popular is because you can get a lot of oil much more quickly than you can with deep oil projects, right? Deep oil projects take 7 to 10 years. You can get wells up and running in 12 to 18 months. Fracking. The problem is that, as Josh pointed out, is well depletion, right? Your well depletion is much faster than, say, a deep water project.
So does fracking, the word fracking comes from fracturing, and it refers to horizontal fracturing of the rock. Is that right?
Yeah, hydraulic fracturing.
Yeah.
And then one thing about what Tracy was saying that I think is important is that there was a story that could be told about fracking that was different from a story that could be told about conventional development like offshore. So the economics for offshore were actually very well understood, and both investors and companies really, I think, were aligned on offshore deep water in many cases, taking a number of years between very, very risky and expensive exploration to delineation to development to production. Shale was relatively new. So with many new technologies that show a lot of promise, you end up very far off the cliff in terms of promises versus reality. And so what we experienced with this was this enormous set of waves of this bubble that's burst. And so we're kind of very much in the aftermath of that. And I'm sure we'll get to that. But that's, I think, one of the important things that, like what Tracy was referencing, is there was this well understood business of oil and gas. And then there was this new technology along with a credit and private equity bubble, and the confluence of new technology that seemed promising with way too much capital chasing returns led to this enormous kind of eruption and implosion.
Got it. So I do want to come back to the issue that Tracy, you had mentioned about the different lead times in these situations. But before that, Josh, is it a fair summary of what you said, that basically there was a period of time of high prices where, I guess, so I'm imagining the credit cycle and the commodity cycle are kind of overlapping, where that credit is chasing after commodities that are needed to build stuff up, and their prices are high, but then it winds up getting spent in overinvestment in infrastructure that is massively decreasing the price of the energy because of the massive supply that comes out of it. And then both those things, the credit and the credit for further investment in that, and then also the sort of wells running dry, make both of those things kind of come to an end. Is that a fair summary of the cycle?
Yeah, so there's actually one thing you mentioned that I left out that I shouldn't have, which is infrastructure. So while all this was happening, there was a boom in building pipelines and, of course, funding those, because, all this stuff was really funded with giant amounts of credit and giant amounts of, and there was some public equity associated with it too, but again, predominantly private equity. And one of the problems was that there weren't enough pipelines from places that were seeing incremental production from shale, and there was too much demand in places that either shale production was banned or pipelines weren't being allowed to get developed. And so a lot of the pain that people are experiencing, and we'll get to this in terms of like a European energy crisis and in terms of, problems in Boston, like Doomberg wrote about a number of months ago, where Boston essentially almost ran out of fuel this winter. These are regulatory problems, and they were kind of legislated essentially, where we just weren't able to build the infrastructure. So we had this great technology, we overdeployed it with this investment bubble that was kind of manic, and then at the same time tried to build as many pipelines as possible, didn't get the ones that we needed done in some cases to get production out from places.
In a lot of cases.
Yeah, go ahead.
Sorry. In a lot of cases.
So this natural gas issue in Europe, is that is that corresponding to this period of low oil prices, or is that starting later than that?
So I think the root cause started with these low oil prices because the LNG market, so the ability to transport natural gas.
Liquid natural gas, right?
Yeah, liquefied natural gas. The ability to transport gas from a place where it's plentiful to a place that is scarce was glutted. And it was glutted partly because of overdevelopment in the Middle East. And it was also glutted because the US was expected to be an importer. And because of the tremendous success, one thing people don't talk about enough, I think, is that shale gas works really well and shale oil works very poorly, just generally speaking. If you think about the energy required to drill and frack and tie into production a shale oil well versus a shale gas well. The gas wells have way bigger reserves, they produce for longer, and it's pretty simple if you think about a tight rock, getting gas out of a tight rock versus getting oil out of a tight rock. I mean, there's even a biblical story about getting water out of a rock, right? So, you think about the gas, it's much easier, right? It's much smaller, it's a much simpler molecule, and it's just much easier for it to get out. So the pricing switched from being for liquefied natural gas being priced based on oil price and a discount to that, to being priced based in many cases on US natural gas plus some sort of transportation premium. And so as that happened, that was kind of the prelude to this, where you had much lower liquefied natural gas import prices in Europe. And I think that might have given people this ability, similar to kind of this notion of the US being energy independent. I think there was this idea in Europe that was building of kind of sustainability of their situation depending on Russia, but like it didn't matter as much because they had this wave of liquefied natural gas coming that was at increasingly lower prices, and they were being promised that there was infinite, essentially, natural gas that could come from North America and other places at increasingly low prices.
Interesting. So when I was reading the Doomberg piece and followed a couple links from it, I was getting the impression that, and I don't want to impute this to them because they've written far more on this than I read, but my impression was that Europe was over relying on wind and then sucking up this natural gas. But I guess the additional part of the story,
that is exactly the problem, is the energy Here's what's happening in Europe right now. They tried to transition too fast, right? And so they tried to have wind and solar, which you cannot have as a base load power source, meaning it's intermittent, right? And so they're trying to transition too fast. We've got to look at this from a macro point of view. They're trying to transition too fast, and then in the meantime, cut off power sources that will provide them with steady energy. And you can see the insanity of their energy policy right now, because you see Germany closing nuclear power plants because it's not green enough, but they're reopening coal plants. I mean, this doesn't make sense at all. So their energy policy is completely misguided, which is exactly what got them into this place to begin with. And quite frankly, what they should have done this summer is, when they knew that they were going to have problems with Nord Stream 2, with getting this through and their dependency on Russian gas, is they should have been looking at the US for long-term contracts. They should have been doing this in the summer instead of doing this last week, in my opinion. Sorry, I'm very passionate about this.
Oh no, that's great. That's great. And so one side of that dilemma, I guess, if I'm reading Josh right, is that the cheap oil gave them the misimpression that helped them make bad decisions by there appearing to be like an endless supply.
Yeah, I mean, here's the situation. The situation is the United States just got met with Europe, right? And we agreed by 2030 we're going to provide them with 50 BCM per year. Now,
what's BCM?
U2's per million BCM.
Isn't it
It's
billion
Times three.
years?
Times three. All I know is times three.
all right. That's a basic unit of
All right.
natural
Yeah,
gas.
it's a basic unit times 3 centimeters times 3. The point is they made a deal with the United States for 50 BCM, which is kind of maxing out our capacity, but we'll see if that happens. The problem is they're at 155 from Russia right now. Russia provides 66.1% of their current natural gas use. So for them to just change on a dime is not going to be easy. First of all, it's definitely cheaper from the United States, plus the cost of transportation. We can totally get it there, but that takes days, right? Instead of the multiple pipelines that are headed into Europe from Russia at the time, right? So you have a lag time on trying to get the gas to Europe. They can also rely on Southern Gas Corridor, which I like very much. Israel's got some really great projects going on right now, and they can also look at TAP pipeline through Azerbaijan. And they're making contracts with these people, but it's kind of the problem is that it's too late. They should have been looking at this last summer, a year ago. I mean, last summer was the big flashing warning sign when Nord Stream 2, they knew they were going to have problems getting the permits available for this particular pipeline. And that's really why Europe is having a problem right now. Is one, bad energy policy. They're trying to transition too fast without knowing, without having a backup plan. And two, relying on Russia too much, knowing full well that they should have been diversifying their natural gas resource assets.
Yeah. So do you think that do you think it's more of just what do you think is the source of this bad policy? Because I mean, I guess one way to look at it is there was no one at the table to point out that the price of fuel as it was back in the cheap days is not always going to be like that. Or is that just an excuse for I mean, what do you think about that? Do you see that as a contributing factor?
I think it's poor energy policy, right? It's governed by the Greens, which is fine. Ideology. You know, I'm all for sustainability. I'm all for renewables. I'm all for let's get pollution out of the air, but you have to plan for this. You can't just say, I'm going to turn on this on a dime, right? You know, it's the same way if you're looking at electric vehicles. Everybody should drive an electric vehicle tomorrow. Well, that's great. Now, can our energy grids handle this? No. We have aging energy grid infrastructure in both Europe and the United States. If we all change to electric vehicles tomorrow, for example, we're going to have we would crash the energy grid. Like we would lights out. So the problem is
I don't know where they get the metals to make the batteries.
And another point, which is also energy intensive, which leads back to energy, is my point. Yeah. But yeah, I mean, you want to redo the energy grid, you have to start from ground zero. Does anybody want to pay for that? No, there's no way you're going to get that through Congress at this point. It would cost trillions.
So if we go back to the pre-COVID point, we basically have the groundwork being laid for bad policy that could be simply characterized as trying to go too green, too fast without a real plan. And that, may be partly influenced by the fact that there's a glut of real cheap energy that was destined to not be cheap forever, and may have led some people to not see the inevitable problems that could come just a couple of years later. If we come up to COVID, so one thing that's sort of famously, the oil futures dropped to negative at some point in April 2020, and at least part of that, I mean, some of these causes are obvious, right? So there were lockdowns and travel restrictions, and so there's very low demand for oil and gas with the view that people are not going to be using it. were there other things during COVID that were there any specific policies that were geared at the oil industry to stop production around that time, or was the oil and other fuel industries, were they self-limiting because of the low demand driven by the restriction placed on other people?
What happened is in February of 2020, you had Saudi Arabia and Russia have a huge fallout within the OPEC Plus alliance in that meeting. And what happened is that Saudi Arabia said, okay, we'll produce as much as we want. Russia said, fine, we will too. At the exact wrong time when COVID came along and the whole world shut down a month later. And so that's really what happened at that point. It was two terrible decisions, two terrible events that coincided at particularly the wrong time.
And so there weren't any, so like oil, I guess oil production here now is lower ever since then, right? And so that's not, there weren't oil industry specific lockdown policies, or were there?
It was complete demand destruction.
Okay,
we shut the world down.
Okay.
Right. Oil demand fell over 7 million barrels a day on day one.
Right. Okay. So given that, one of the things that you had brought up towards the beginning, Tracy, was the different lead times involved in shale versus traditional oil. Could you guys, either one of you, jump in on this? Describe a little bit about, if you shut down an oil well, how easy is it to get it back online? What is the type of investment that goes into that? And what role does wells having been shut down during that period play in difficulty of getting supply back up?
I can address that.
I was going to say, I'll let Josh take that one.
Yeah. So I think it's important to remember that this was a sort of left tail event. There's basically almost no precedent in history for global economies and societies to entirely shut themselves down in the way that we did. I mean, even during like the Black Death or whatever, it was not way high mortality rates, and this just didn't happen. And so I think it's important to start with that in terms of understanding how bad it got. And the Railroad Commission and others did consider sort of forcing some degree of shut-ins, and in the end, that just didn't happen. And so, maybe it would have taken too long, maybe various other kind of considerations, but it just there wasn't. Ultimately, just market forces to some extent took place. In terms of turning,
can I stop you for one second? What's a shut-in? Is that an order to not produce out of the well?
So the history of the Railroad Commission, they actually used to regulate oil production very heavily, and to the point where they'd allow or disallow production from certain leases, and they set price. And so, there is this history where, in theory, the regulatory body could control a lot, and the decision was that it was inappropriate at that time to attempt to do that. So when you're turning off and turning back on wells, there's always a risk of kind of disrupting the reservoir. Certain reservoirs are actually much better oriented towards being shut in and turned back on. In particular, shale gas is great for that. When you shut it in, you actually repressure the reservoir, and you have a decent shot at actually improving your total ultimate recovery. And when you turn back on your wells, you get this flush production. To a lesser extent, that's true for oil. The problem is, from a shale perspective, sometimes you end up damaging the reservoir by keeping it shut in. And often you require well intervention of some sort. So whether it's just cleaning out the stuff right by the wellbore, or whether it's going down into the legs, so the horizontal portion, and having to do various things, whether it's re-stimulating in some minor way, or cleaning out blockages, or various other things, or sometimes wax will have built up. Again, there's maybe 100 different problems that can happen, but way more common with oil. And then on the conventional side, way bigger deal than with shale, because with shale, generally allowing increase of pressure allows more ultimate recovery. And with conventional production, in some cases, you have water flooding, or you're pumping CO2 down into the reservoir where you essentially capture the CO2 and then get oil or gas, or usually it's oil with water or something, back up. And so those sorts of operations suffer tremendously if you turn them off. And so most of those didn't really get turned off. And I guess the last category are stripper wells, which is basically wells in the very end of their life. And those sorts of wells, if you turn them off, often you don't want to turn them back on absent much higher prices. And so we've seen some wells that people thought they were going to get rid of getting turned back on very recently as oil and gas prices have been a lot higher. But it did look like there were going to be a lot of reservoirs that were going to be just turned off forever because of that shutdown and that low price environment.
So if you were to just kind of guess based on, I don't know if you've done analysis on this, or if you just want to throw out a number off the top of your head, like what proportion of the difficulty of getting oil supply back to match the demand since COVID could be attributable to having shut down more wells than would otherwise make sense to if you were trying to manage it properly?
Yeah, I don't think that's really the big problem. I think the problem is that, as one would anticipate, the world economy is this really complex thing, and central planners always think that they understand it. And the Fed's predicted 0 out of the last 10 recessions, and other economists have predicted 20 out of the last 2 recessions. So it's just this thing that's very difficult to understand, and I don't think any one person or group really truly understands it. So you have this, imagine, enormously complex machine flying, right? So it's flying, but it's got a combination of jets and hover stuff and 5 other propulsion methods. And you decide to just stop it. And you don't even really give good guidance, right? You throw some PPP money, you throw a few other sort of emergency whatever things, and you basically are building cushions so that when the thing collapses, which it does, it won't get too damaged, and then is somehow able to sort of pick back up. And I think that's maybe a good way of thinking about what happened in general to the economy. And when you think about it specific to oil and gas, there were all these complex supply chain processes. There's all this stuff happening. People were drilling wells and then completing them later. They were planning on all these different aspects of things. And all of that stopped. Almost all of it stopped almost entirely shortly after these various lockdown orders and so on. And so when you see, it makes the government coming out and criticizing oil companies now, which weren't really bailed out relative to other industries, particularly grating, because of all of the things to shut down like that, really complex industrial processes did worse even than restaurants, because restaurants have some basic stuff, but really a lot of that stuff turns really fast.
And they weren't even looking at the fact that how much money did that industry lose from 2014 onwards. Really, for the last 6 years, that industry has been a great drain. So they're making money for the first time in 6 years. Fantastic.
I want my phone subsidy. I want them to do the first stop is to break the tech monopolies, and watch this broadcast get cut by Google right now as they hear this.
I know, right?
Break the tech monopolies. And if they want to do something, and again, I'm generally against government intervention in economic stuff. I think the government generally does more harm than good. But if the government's going to do something, let's focus on the companies that earned profits for the last 10 years, not the ones that were essentially nonprofits providing energy at subsidized prices for most of the last decade. So
exactly.
But specifically from what the disruption is, I'd say it's over 90% related to the shock to the industry that was not built to start and stop, of this just sudden, extreme, forced stop. And exacerbated by OPEC, exacerbated by other stuff, but really just this forced stop and then start again, rather than focusing on the reservoirs themselves, which for the most part actually performed quite well.
So then it's less about the physical stuff going on, and it's more about the massive interruption in the ability of all these companies to plan, basically.
Right. And this is what we're going to actually see in Russia right now. This is what Europeans, or what we should be looking at when we're looking at all of these sanctions and all of these things happening with Russia right now, is because Russian oil is produced majorly in very, very cold in the Arctic and Siberia, right? And so if we start seeing pipes back up and them having to turn off this production is not easily turned back on. Again, this is not shale. This will take months and months and months and months. And so this is really what traders are looking at right now, as far as, you know, how much Russian oil is going to be actually taken off the market and how this will affect future production.
And is that because the nature of the
trying to turn around? I know this was kind of a weird segue, but since we were talking about taking oil off the market.
Yeah, there's a number of open threads that are really important here. So are you saying that the Russian oil as it is produced is more traditional in nature, and you will have more of a physical reservoir problem from shutting
Correct.
it down now?
Especially because of the climate it's in, because of the extreme cold nature of the climate that
the stuff
is producing in Siberia and the Arctic.
Right.
You're going to have really, if you have to turn off those wells because the pipelines are filled, you cannot turn those back on in a month.
Interesting.
It's going to take months and months and months to turn those back on. And you're also, not only that, you're going to need service companies to help you do that. And since American service companies have decided not to participate in those markets any longer, like Schlumberger, Baker, etc., they're going to have a hard time turning those back on themselves if this is out of the market. And so this is why this is kind of such a big deal, even though we don't technically have sanctions on Russian oil. We have people shunning oil, so we have self-sanctioning this oil. And so if it becomes a problem to where they actually have to turn off these wells, that's where we're going to see a real problem in the market.
And the standoff with the ruble is looks like a game of chicken that who knows where it's going. So the physical disruption of reservoirs is a real issue, but as Josh was saying, it didn't really apply to American production in the COVID pandemic so much as the disruption in planning that comes. It's very interesting because there's a lot of, I had posted that I was having this discussion a few days ago on Facebook, and it turned out the comment section turned into a discussion about how like something so important as oil shouldn't be privately owned. And so I decided that I didn't want to go there, but it's very interesting that like we're looking at this and seeing this as a market economy that where prices are being set by supply and demand, but actually like the lockdowns were very centrally planned. And so, if you're trying to participate in a market economy and judge the fluctuation of prices and all that information that is coming to you, and then all of a sudden some centrally planned event comes in and says, no, this price is zero. I can imagine that hurts planning a lot. One thing that you both brought up was about the profits and losses. And I do want to come back to that and hammer it in a little bit, because I think this is sort of like some people understand it, most people don't. But right now, one of the criticisms of the oil industry is these guys, what are you talking about? They need to charge money for the oil. They're making record profits. And I don't think many people understand that the oil industry often registers losses. Could you just elaborate on that point a little bit? Is what would be the right, if you were trying to judge the profit, and I don't really understand the like the stocks, but I know, like Josh, you've mentioned how undervalued the stocks are, and it's kind of like I guess the oil industry is sort of like a the whipping boy of like, it's not cool to own oil, but
it actually is. That's actually funny.
But so it's sort of like saying you own oil is sort of like admitting that you're a smoker in like 1999 or something like that. But so there's must be that part of it. But can you just comment on like what's the right metric to view how profitable these companies are? Presumably you would want to use like a 10-year average or something like that. But like, what's the right way to frame the record profits that oil companies are having right now?
Yeah, I mean, like, use a 5-year trailing or a 10-year trailing. I mean, you can look at return on equity or return on invested capital from an industry-wide basis. And then I do want to comment on I'll keep it very brief. The US oil industry, if it were government controlled, would functionally not exist at the scale that it exists right now. And the way I can say that is that there are similar shale reservoirs in Argentina and in other places that are not able to be accessed because of the essentially socialist control, central planning in those countries. And with similar reservoirs, Argentina has like 1/20th or something of the shale production that the US has, with reservoirs that are similar. Canada, which is frankly fairly centrally planned, extremely heavily regulated, taxed in ways that the US we're just starting to dream of, unfortunately, has similar reservoirs too, and has I think it's like 1/4 or something of the production the US has. So it's not this is so important, therefore the government should own it. It's this exists because it's not mostly government owned. And the more that the government comes in and regulates it and taxes it, and I mean, it's like the Reagan line, right? Like, the scariest words you can hear are, "I'm from the government and I'm here to help." The more that happens, the less that it'll exist, period.
And could you comment off the top of your head what the 5 or 10-year trailing average would be on the profitability? Is that
nonprofits? It's a nonprofit industry.
Is it basically
we need
zero
to get
out?
like chaplaincy write-offs or something on our taxes.
All right. Yeah, interesting. Okay, so another criticism. There's a couple other criticisms of the oil industry that are a little bit more specific and a little bit less naive that I want to get your feedback on. And I guess I'll start here. So Biden said they have 9,000 permits to drill now. They could be drilling right now, yesterday, last week, last year. Can you talk a little bit about like what is involved in getting US oil production back to meet the demand? And what is your response to, what are you talking about? You can't drill. You have 9,000 permits.
So, I mean, there's a few things. So one, simultaneous to these criticisms, there have been material additional regulations that suppress drilling, completion, and production activity, as well as transport of oil. There have been additional regulations and regulatory guidelines that have started to get pointed at banks and investors and various other financial aspects of the industry. And basically, it's like very strange to see this, where it's kind of this stick thing, where it's like, we're going to beat you until you produce more, and we're going to beat you to prevent you from producing, and you're definitely not getting to transport any of the stuff that you're producing. You have to stop transporting the stuff you're currently producing, and we're definitely not going to let you transport more, but you need to produce more right now. And so it's a rhetorical thing, and it's scary, because when people say contradictory things simultaneously and in the same day implement things that are within the executive purview, right? These are government agencies that are controlled by the president. It's very, very disingenuous and very alarming, because the history of these things is when you have that sort of duality or whatever, you end up with really bad policy, and you end up with shortages and other sorts of kind of horrible things.
Oh, see, we got Josh just as mad as me.
Is the financing sticks? Is that ESG scoring?
The SEC is now apparently going to be regulating climate change, and so you're going to be liable.
It's such a complete joke. I can't even tell you. Right.
Yeah, I mean, it's really,
that's wild.
They can't even do their own job right now.
I don't want to criticize
climate change policy.
I don't want to criticize any particular government agency. The SEC does important things, as do other government agencies. I think it's really hard when you have that announcement reminded me of,
you they have dual mandates. It's too hard. You have to have, if your government agency is supposed to focus on this, then this is what you should do, not have dual mandates that are outside of your particular primary mandates. It's too much. We don't have enough money for these regulatory agencies to completely go off on the deep end on a mandate that is not in their purview, is my opinion.
Is SEC, what's SEC doing, saying how would they regulate the financing of climate change? What does that mean?
It's going to be related to company disclosures. It's going to be, it looks like, and again, these guidelines are still evolving, which again introduces uncertainty, introduces risk from an investment perspective, both as outside providers of capital as well as for companies that are choosing to invest or pay off debt or return capital in some other way. And, there's potentially going to be liability. They're floating carbon taxes and other sorts of things where some things that might be disclosed could be used. There's many active lawsuits that are not getting thrown out, at least so far, where companies are getting sued. Producers of oil are getting sued for climate change or for various environmental factors that may or may not be attributable to their activity, but certainly they're not the ones driving cars that are consuming it, these various things. So it's a very, very kind of risky or very, there's a lot of landmines out there for oil and gas companies. And this is one that's like evolving right now. And so we don't really, I guess what I'm saying is there are some observed things, there are a number of things that are kind of implied that aren't quite there yet. And ironically, it's chilling, one, because there's already been pressure from the Fed, which is apparently also regulating equity and climate change.
As well?
Yeah, the Fed has been doing that. They've accepted that as a dual mandate. They want equity, and apparently climate change is a part of equity too. And so they've been pressuring banks to lend.
That's a quadruple mandate they have now, isn't it?
Yeah, but I think I agree with Tracy. I think it's important. I think it's important to have. I'm very libertarian, but there are things that need to happen, and for them to happen, there need to be people and groups that make them happen. And laws need to be enforced, contracts need to be enforced. We need to have safety and security and so on. These are important things. I'm not questioning the mandates. It's when you add these extra things like armed IRS officers, like what the heck, right? The FBI isn't enough. Like the FBI is great. The FBI should do the FBI thing. The IRS should do the IRS thing. Or like when you merge these things, you end up, I think, with very weird situations with potentially very bad outcomes. And right now you're doing that. The federal government, at the behest of the president, is actively doing that to suppress oil and gas investment and production and activity while simultaneously criticizing the industry for not doing
telling them to produce more, which is completely what we need is a revamp of, we need a cohesive energy policy moving forward, right? And so we could take something such as natural gas, which is the perfect transition tool. And we have a lot of it in the United States, right? Instead of saying, we don't want this, but oh my God, we need to lower oil prices. So can you produce more? But we don't want you. I mean, it's a completely schizophrenic message right now going on, right?
So you in the oil industry are now feeling what some of us in the nutrition space were feeling quite a while ago, because in 2008-ish, when they started militarizing all these federal bureaucracies, the libertarians were kind of on top of it. They were like, why, I don't remember which bureaucracy got which weapon, but it was like, why does the post office need tanks and stuff like that? And there was a very, I think it was quiet to most people, but those of us who drank raw milk that was purchased directly from farmers, or who were engaging in one thing that was floated at that time as a legal construct was people who wanted to drink raw milk, as an example, they would buy shares in a cow. And so if the state allowed you to drink the raw milk of your own cow and didn't allow you to sell it, they weren't selling it to anyone. They were drinking the milk of their own cow. And this was a successful model that started winning in the courts. And the guy who invented that model ran a food co-op in California called the Rossum Food Co-op, and he now he moved to Thailand because he thought that there was a conspiracy to off him, and he fell off a railing and died. But anyway, if you go to Google Images and you search Rossum guns drawn, you'll see images of the feds with their guns pointed at people where they would raid the Rossum Food Co-op and take like hundreds of thousands of dollars of food and just destroy it. So we're familiar with the whole what is the IRS guns type of thing. But anyway, so all right, so the SEC, like, is this primarily coming from, like, what is the effect of that? Is it primarily to discourage investment because people view it as too risky because they don't know like what those disclosure
No, it's to
requirements
discourage investments because this is because of the climate Paris Accord, right? We want to lower carbon emissions, so everybody needs to stop oil and gas now, right?
But is it coming in the form of like the SEC is punishing people, or is it coming in the form?
We don't know yet. This is all brand new.
Right. Okay, got it.
There's an aspect of it that's chilling, right? So if you have to disclose certain things that aren't necessarily your purview, right? If you have to disclose the emissions of like the steel that you're using for your pipe to drill a well, it gets very complicated and you could end up potentially liable. And so there's these multiple layers of things going on simultaneously that are very similar, I think, to what you were describing in the food industry, where there's this risk of like almost, I think the head of Shell or one of the big oil companies said this in a conference last week, that you feel in the oil and gas industry almost borderline criminal for what you're doing. And it's very weird to see that attitude and that sort of regulatory framework being perpetuated at the same time as you're being criticized for not doing more of it. It's like, come on, guys, like make up your mind. And so that's where the 9,000 well thing is just complete bogus. Like it's just fake. And when people mention it like as a real criticism or concern, it's just evidence of not understanding what's happening. And so it's like an easy heuristic, right? There are various things like that where someone says, hey, there's this. You just know that they don't know about all these other things. And so, it's helpful, but it's also frustrating.
So what then is the sort of like the mechanistic link of why supply of oil is not catching up with demand for it? Is it that the capital is dried up because we're on the other side of a credit boom and all these things are discouraging investment, or like what is the why can't they use these 9,000 permits to build more wells if what we need is more supply of oil?
I mean, it's a cost of capital issue. So when you have the president of the United States in his first day canceling pipelines that are needed to transport that oil, it doesn't make so much sense to then go drill wells in that place where they just canceled the pipeline. And then when they start introducing additional regulatory scrutiny and burden on wells drilled on those permits, using those permits, you don't really know that you have them, and then you can't necessarily get a loan from the bank to go drill those wells because the banks are subject to this additional scrutiny that just keeps increasing, as well as additional burden. It's not just being scrutinized; it's also they have to mark the loans a little differently, and that's the prelude, like we saw in the financial crisis, to less loan availability for certain things. So we saw this with housing and other stuff, and it's why it took so long for the housing market to recover. So you have this regulatory kind of boot on neck at the same time as you have a moderate recovery from a down investment cycle and a down credit cycle. And so you have the business fundamentals, which would have meant that this would have been a slower recovery than normal because the downturn was so extreme. And it's coinciding with just tremendous pressure from many perspectives that have led to very high costs of capital despite a profitable period for the industry.
So I'm going to have Michael Howell coming on from Cross Border Capital next week to talk about liquidity. And I saw him on Real Vision with Tony Greer last week, and he was saying that as the liquidity shrinks, that because oil is often, if I understood his argument correctly, because oil is often used as like collateral for refinancing, as the price of oil rises, it actually contributes to the contracting of liquidity. Does that make sense to you, or? if I'm understanding it right.
I'll let Tracy address that.
I mean, I did not see the segment, so I'm not quite sure about the argument. If we're talking about oil prices right now, and what we have seen over the last year or so, is that not, if we're talking just about the paper markets, right, which is the futures markets, we have seen that being used as a hedge for inflation rather than traditionally something like gold. So I don't think that I don't think I quite get that.
I may have misunderstood his point. I might not
exactly. Yeah. I'll have to watch this. I'll have to watch that.
I'll have to ask him about it because I'm not even sure if I'm explaining what he was saying correctly. So we'll skip over that.
Okay.
Okay. So one of the, I guess this kind of leads into the last criticism that I wanted to run by you. So, there's been a couple criticisms of stock buybacks in oil companies. And so one that came out earlier was that, in the pandemic response, they were giving, 15.5 million in government, COVID funds to two oil companies that had bought back their stocks. And that article was basically arguing, like, why should we be giving money to a company that's just using the capital to buy back its stock? And then Robert Reich has recently said something. Let me just read this to you and get your thoughts on it. So he says, Joe Biden is proposing stricter regulations on stock buybacks in his newly released budget. Since Ronald Reagan legalized stock buybacks in 1982, corporations have used the practice to artificially inflate their stock value by buying back shares, lining the pockets of executives who are largely paid in stock options. The Biden administration proposed a 3-year freeze on corporate executives selling their shares after a buyback. Stock buybacks incentivize corporations to put shareholder returns above workers and consumers. Big Oil, for instance, is planning on spending near record $38 billion on stock buybacks this year, even as everyday Americans are squeezed with higher prices at the gas pump. Biden's 3-year freeze is exactly right, but why not go a step further? It's past time to make stock buybacks illegal again and stop enabling corporations to rake in record profits at the expense of workers and consumers. So we already dealt with the record profits thing, but what about this idea that, how can you on the one hand say that there's not enough easy capital, and yet billions of capital is, instead of investing in supplying more oil, is being invested in stock buybacks? What's the right way to frame that?
Yeah, so I guess that's really simple. There's been so much pressure on the industry, and it's so out of favor, and it's continually being the capital is being withdrawn from the industry actively right now. Still, there was a giant insurance company that just pulled capital, Apollo and Blackstone and others in the last month.
Every bank has come out and said that they're withholding capital from the industry and they won't fund the industry. So sorry to interrupt.
Yeah, no, for sure. Right. So, but it's even happening. I think the point is that's happening now as the companies are being criticized for not spending. So what happens is if you pull capital out of an industry, you raise the cost of capital for that industry substantially. And at a sufficiently high cost of capital, it's economic to return capital instead of deploying capital. What you should want, if you want more oil production, is higher share prices for oil and gas companies and lower costs of capital. Again, it's like how you can tell that they don't actually want more oil and gas production. They just want an enemy or a bad guy to point to. Buybacks only make sense where there's a low share price versus the amount of profit generated by the business. And, the history of corporate buybacks is very mixed. But the buybacks going on right now in oil and gas are reflective of the very high cost of capital and have very little to do with this sort of like political grandstanding. So again, I think it's just a question of like, do you want a whipping boy?
I just want to point out, it's not just the oil and gas industry, right, that has huge stock buybacks right now. This is tech makes oil and gas look ridiculously small. So
yeah, that's a good point. I
just want to point that out.
Yeah, that's a very good point. No, I totally get what you're saying. Like it makes no sense to single out oil here. But I'm just trying to understand, like, mechanistically, like, is that like this $38 billion that's going into buybacks, is that of a huge amount of money or a small amount of money compared to like if there was a booming oil supply, how much money would be coming into it from like rolling over, refinancing like a rich supply of capital? Like, does that $38 billion, like, are people right to say like, well, that could have gone into into supply? Like, is that a big amount of money or a small amount of money compared to like the total capital needs of a robust oil supply?
I mean, I think the global oil industry is spending, I don't know, it looks like $400-ish billion this year. Maybe it's more. So that's a small fraction of the total amount. The big problem is that many companies that I talk to would actually like to drill more. So even with all these regulations and restrictions, the problem is that the government shut down the world 2 years ago and the supply chains are broken. And a lot of these companies, when the world was shut down, oil companies in particular were hurt because the price was forced so low because people weren't using their product. So they're still dealing with this enormous negative price shock. And so as they're recovering from this, the whole supply chain, the whole value chain for oil services has gotten decimated and they're rebuilding it. The problem is if you threw $38 billion at drilling, let's say you tried to drill more shale wells in the US with $38 billion today, you might get $10 billion worth of more shale wells drilled. The rest of it's just going to go to service cost inflation. So if you're a service company, you want this. If you're a producer, you don't want this. You don't really have in many places enough pipeline capacity. So like in West Texas right now, they're filling up the gas pipelines. Why are they filling them up? There's tremendous need for gas, but like try getting a US-Mexico interchange, try getting an LNG plant approved. And they're starting to get approved, but there's just this whole giant mess. So it's a little bit, the problem is when you have that big complicated machine and you like crash landed on these like pads that you've kind of hastily built, trying to have it be up and running at full speed again, and then throwing stuff at it because you're mad that it's not going fast enough, and then like launching rockets at it. I mean, that's essentially what we're doing. And like Robert Wright, I mean, like these guys were very much in favor of the shock and awe, shut down everything based on flawed math and bad science and so I guess it's not a surprise that they would then use bad math and bad science to criticize other things. I think it's maybe consistent, but it's their fault. So if they want to criticize someone, and so it can never be their fault, it always has to be someone else's fault. So they found something that's very unpopular and that they've criticized historically for many other things. And now these are the people to blame for everything. So again, like relatively speaking, that's a small amount of capital. If the share prices were expensive and not cheap, if they were valued like tech stocks, like in Cathie Wood's whatever innovation,
which they're not.
Not.
Oil and gas stocks are super cheap, right? Comparatively speaking to anything else out there right now.
Yeah. So that's a very not cynical view of this, given that there's certainly some people who want gas prices to be high. I mean, there are politicians that have come out and said that. And, some of this just kind of looks to be aligning, like some people would prefer there be shortages of all kinds of stuff.
Nobody wants shortages. Nobody wants shortages.
I don't know. Some people
okay. I'll say most people don't want shortages.
No, I don't want shortages, but I think unfortunately there's a lot of people, like when you have these sort of emergency events, you end up with people that benefit a lot, right? Like,
of course.
Yeah. So look where the money goes. And
I'm not going there. I'm not touching that today.
But it's not the oil companies, right? Like, oil companies aren't earning that much.
No, I wasn't suggesting it was the oil company.
No, I understand. But I think when you worry about these things, I think you just look at, okay, who benefits, who wins, where did it come from? Why is there a problem? And okay, your big complicated thing, you crashed it, you sent it back up. Now you're like shooting stuff at it and upset with it because it's not going faster and working more flawlessly. And so you have to kind of pick, are you trying to help it along or are you trying to crash it again? And I kind of like this allegory. It's like why I keep going back to it. But I think really what you have right now is you have the policymakers in the US and other places both criticizing it for not flying more smoothly and faster, and shooting rockets at it and guns at it and all kinds of other things to try to like crash it again. And so you can't have both. And if you're the one with the gun or the rifle shooting at it, you can't, I mean, it's massively hypocritical to also be complaining about its trajectory and speed.
Agreed.
All right. So when I had kind of outlined, I want to talk a little bit about like fertilizer before getting to policy responses, but I feel like we've gotten into policy responses a lot. So I think we should just continue with this thread. So I guess maybe we can make this like a rapid fire section, although it doesn't have to be like a super quick answer, but
I have just a few more minutes, you guys. I'm
okay.
Sorry.
All right.
I have to head out to dinner soon.
Okay. Then let's Tracy, could you then give like I know you went long fertilizer in September 2020. Grab that from your Twitter. Could you just kind of build on the discussion of oil and just explain the rationale for how this is feeding into the fertilizer market, and what are like what is this all is it all about if oil price is high, then it costs more to drill minerals for fertilizer, or is there more going on than that we should think about?
Well, okay, so you have to first realize that energy is basically the basis for everything. So my thesis at that point was I knew because of energy policy and what was going on, and because demand was coming back faster than after we shut the world down and we shut down so much production, I knew that we were going to see higher energy prices. When you're looking at, I see higher energy prices in the future. Now, what does that affect? Well, definitely that affects agriculture, right? Because they're highly dependent on diesel and propane, just on the energy side, right? And so then what are the inputs to agriculture? Fertilizer. What does fertilizer take to produce? Oh, a lot of natural gas. Right. And so you have to kind of go down the line and figure out, again, the secondary and tertiary effects of what are higher oil prices. And then we also have to look at, and we can flip this to metals too, right? And so mining is very energy intensive. It's going to take a lot of energy to mine all of these rare earths and metals that we need for this new energy transition policy. So I knew that, again, that's going to drive up energy prices even higher, because if you want to have all of these metals, you're going to need a lot of energy to do this, right? And so it's a vicious cycle, and all three of these industries are completely interrelated. And that's exactly where, my thesis initially came from.
All right. So
that makes sense.
Yeah, that's great. Let's kind of try to conclude this with like some practical thoughts on what to do about it. So I know, Tracy, you've mentioned that what we need is a coherent energy policy. Like and actually before we get there, I do have one question on clearly there's a lag time in terms of like oil is needed to mine metals, which is, and minerals, which is needed to make fertilizer, which is needed to this, and then it gets into a growing season. So one question is what should we look toward to see this resolved? But what would be the lag time between resolving the energy problem and the fertilizer problem? And how long would that take to play out in getting food prices to come back down?
Well, I think you're talking years here, because this problem is 7 years building, right? You have a lack of capex over the last 7 years in the oil industry, and the metals industry is basically facing the same capex problem the oil industry is. And so if you're talking, 7 years to get to where we are, then I think, it's going to take another 5 to 7 to 10 years to resolve this problem, unless we can somehow resolve the renewable energy problem before then. And I'm not talking solar or wind, because those things take exactly the metals and minerals that we need to build this, but we'd have to, I don't know, some innovation in nuclear or something that comes beyond that in hydrogen. Or, I mean, there's lots of other avenues, but just not there yet. And that's exactly why we're at where we're at right now in the energy problem that we are. It's because people think you can just turn off oil and gas and you can turn on wind and solar, which the technology is just too far behind.
So your thought is we should basically expect to see high food prices for about 5 to 10 years after
for a while. Yeah, I think
after we resolve the energy problem.
Yes.
All right. Josh, do you have another like 10 or 15 minutes to answer questions?
Yeah, I can stick around for a few more minutes after this.
Okay. Tracy, do you have to run or?
So, yeah, I mean, I'll stick around for one more question then.
All right.
Sorry.
Oh, no, that's great. All right. So I just want to run through like some of the policy stuff that's going on now. So I guess like just like quick thoughts on each of these. So we have obviously in the news we have the SPR release. Like good or bad for solving this problem?
Okay, I'll go first because I gotta go. This is terrible. All right, so aside from the fact that the SPR is supposedly for emergency reserve, right, and that means a threat to national energy security. Right now, we do not have a threat to national energy security. When we have gas lines and we have no gas, that's when we have a problem. This is not a problem. This is not what we should be doing right now. Also, it's a band-aid, right? It doesn't solve the overall structural supply deficit within the market in years to come. Also, it slows shale growth as it discourages E&Ps from drilling more, which is exactly what needs to be done right now. We also have a problem of potential logistics problems, right? We've never released this much into the market, so we don't know what kind of bottlenecks this creates, and this may actually hinder production. E&Ps may have to curtail production if these congestion points get too bad. Then if we look at just the SPR within itself, right? In 2015, the Biden administration enacted a policy in which they would give $2 billion over to 2015 to out to 2030, actually, to revamp the SPR because it's badly in need of repairs, right? And that's great, except for the fact that so far what they've done is they've only done repairs to a few logistic things. What they have not repaired so far is distribution centers. And so we don't even know if distribution centers are going to be able to handle 1 million barrels per day because those haven't been upgraded. We also have another problem that the last time we had a big SPR release, we found degradation in the barrels that were in salt mines. And so we had a problem with those barrels being able to be sold up the market because there were problems with the quality of it. And so there's a lot of problems that we're going to see within this SPR release. It's all nice and well to say we're going to release this, but there's a ton of problems that people are not discussing right now with this particular release.
Thank you. Did you want to add anything to that, Josh?
No, I think she did a good job with that. I agree very much.
So we have a collection, I guess, of other things that are coming out that are either stimulus checks or rebates for gas purchases or other forms of like lowering the government taxes on gas. I mean, it seems to me that these are driven at sort of like relieving pressure on consumers, but they all will increase demand for gas. What are your thoughts on that? Like it seems like we
Gosh,
have
you and Cuppy have been talking about this forever. You go.
Yeah, we did. We kind of forecasted. I think Cuppy was ahead of me on that by just a little bit. And we're referencing my friend Harris Kupperman, who runs a global macro fund and has been calling a bunch of these things right. Specifically, this one was a pretty impressive call. So I'm personally in favor of tax cuts. I'm generally not as much in favor of stimulus payments because there's a difference in psychology as well as a difference in kind of practical implementation. And yeah, to some extent, cutting taxes on fuel does end up driving a little bit of additional consumption, but more importantly, it reduces the negative burden of a particular thing. So if the problem is gas prices being too high and therefore hurting people's budgets and making them not be able to do things like drive to the grocery store, cutting the gas tax directly affects that. Whereas sending people like fully loaded, I think I saw Chicago, they were just like sending people ATM cards that had cash on them, or debit cards. That's generally a much less good idea. You end up not necessarily facilitating facilitating economic activity or reducing the burden. You end up, and money is fungible, but it seems best to actually affect the problem. And then from an affordability perspective for gasoline, if you look at gas prices in Europe and in the US, in many places, the combination of direct taxes as well as the price from regulatory impact is greater than the price of actually the oil contribution into the gasoline. So you're paying the government more than you're paying the oil companies. And again, the oil companies have to spend a lot of money to get that oil to you in the form of gasoline. So it makes a lot of sense to me to see tax reductions on that. And I think it's less about stimulus and more about reducing the burden on consumers from government intervention.
And I guess, thank you. And I guess I'll just sort of make this last question. Is there anything that you see missing on the horizon in terms of what is needed to actually drive a resolution to this? I guess obviously you mentioned a lot of hostility towards the drilling, but like where do you, I guess, what would be the signs of, sort of right policy responses lining up that you would look for to say, oh, we have a solution to this problem on the horizon? What would you be looking for?
I mean, I've started investing more in growing oil and gas production. Like I see it as a real problem, and the poorest and least able to fend for themselves in the world are hurt the most by it. So I want there to be more oil and gas production right now. There is a shortage. It's having all kinds of knock-on problems. Institutions won't invest in what I'm doing, and they won't invest in what my competitors are doing. They're just not, they're being told by the government that this is like a good thing to not do it. And I think as long as you add more regulatory burden to investing in oil and gas through various mechanisms, you reduce the investment in oil and gas. If you destigmatize it, which leaders can do in theory, and you deregulate it, which leaders can do in theory, you facilitate investment in it, not buybacks of shares, but drilling and more supply. So what you're seeing again is the opposite of that actively today, right? Every day you see it. And what you need to see to know that that was changing is a 180 on that and encouragement of investment. And it's just not, we're so far from that. We're off the cliff really far, and we're still running. We're not even, trying to get back.
I think we need to see actually open conversations, right, between government bodies and the industry. And I realize that there are lobbyist groups and all of this, but I think it's going to take some real, honest, hard conversations and really looking at the industry and really looking at what is positive about the energy industry. I mean, natural gas is a perfect transition fuel. It's a clean burning fuel, regardless of what anybody says. Here's a fun fact. The only reason that you smell nat gas, right, is because they actually put the rotten egg smell in nat gas so that if you have a leak, right? Otherwise, you wouldn't even be able to smell it. right? It's a clean burning fuel. It's a great transition fuel. And I just think that governments and people need to start having honest conversations about this and not run with this narrative that is hurting us right now, to be honest.
All right. Well, thank you so much. You've been very, very generous with your time, and you've done an amazing job in helping me understand some of the basic building blocks that are moving towards this food situation. And I really appreciate it. So thank you, guys.
Thank you.
Thanks a lot.